In this chapter, we're going to look at valuation and investment analysis of income producing properties. When it comes to income producing properties, market value is a key consideration for financing or investment. Market value is the most probable price which a property should bring in a competitive and open market under all conditions requisite to a fair sale. The buyer and seller each acting prudently and knowledgeably, and assuming the price is not affected by undue stimulus. Let's look at the appraisal process. An appraisal is an estimate of value. In making this estimate, the appraisers use systematic approach referred to as the appraisal process. This includes physical and legal identification, identify property rights to be valued, specify the purpose of the appraisal, specify effective date of value estimate, gather and analyze market data, and finally apply techniques to estimate value. Let's look at the approaches to evaluation. First, we have the sales comparison approach. The sales comparison approach is based on data provided from recent sales of properties highly comparable to the property being appraised. To the extent that there are differences in size, scale, location, age, and quality of construction between the project being valued and recent sales of comparable properties, adjustments must be made to compensate for such differences. We also have the income approach. This approach to property valuation is based on the principle that the value of a property is related to its ability to produce cash flows. The methods used include gross income multipliers, capitalization rate, and discounted cash flow techniques. For the gross income multipliers, these are relationships between gross income and sale prices for all comparable properties that are applied to the subject property. The gross income multiplier is equals to sales price divided by gross income. Let's look at a practical example of application of the gross income multipliers. Assume you are considering the purchase of an urban office building with an estimated gross annual income of 2.5 million. Further, assume that the average gross income multiplier of several comparable urban office buildings is 2.7 times. Compute the value of the subject property using the gross income multiplier technique. So with this, you'll simply multiply the 2.5 million by the gross income multiplier, and with that, you'll be able to have computed the value of the property. So in this case, 2.5 million multiplied by 2.7, you get 6.75 million. Now let's look at the capitalization rate. Capitalization rate is useful in situations where differences in operating expenses exist between comparables. The focus shifts to net operating income. So the value is equals to the net operating income divided by the capitalization rate. Let's look at an example with the capitalization rate. Assume that net operating income for an office building is expected to be 175,000 and the capitalization rate is 8%. Compute the estimated market value for this property using the direct capitalization approach. So with this, we'll take our net operating income and divide it by the capitalization rate. So this will be the $175,000 divided by 0.08, and we'll find the estimated market value to be 2,187,500. Let's look at limitations to the direct capitalization approach. It's difficult to select appropriate capitalization rate without adequate data. It's only applicable for monetary income generating properties. Limitations to the gross income multiplier approach include the sales prices for comparables may not be current. Rental income may not be available. Gross rents may be inaccurate when building to land ratios and building ages are different. Sales prices may be affected by factors that render the gross income multiplier inaccurate unless comparables are exposed to these same factors. Not useful for unique properties or properties that produce benefits instead of income. Now, let's also look at the discounted cash flows technique. This technique is based on the principle that investors will pay no more for property than the present value of all future net operating income. The steps of calculating the discounted cash flow, or rather the steps involved in the discounted cash flows technique, are as follows. First, forecast the net operating income. Then, selection of relevant period of analysis or the holding period for the investment. And then the selection of a discount rate or required rate of return. And finally, computation of the reversion value or the resale value. In making the estimate of the reversion value, we make the following assumptions. The demand for the property will tend to grow in a stable long-term relationship with the growth in the economy. There will be no major or structural changes in the determinants of supply and demand for such properties after holding or after the holding period. Using the terminal cap rate based on required rate of return, the expected growth in long-term cash flows, G, the terminal cap rate from sales of older comparable properties, and finally estimating the reversion value based on expected changes in property values. So the following is a 10-year forecast of ABC apartments. The net operating income will stabilize at a growth rate of 2% in year 9 and thereafter. The required rate of return is 12%. Compute the present value of the ABC apartments. So with this, we can jump into Excel and compute. So for this example, we have the net operating incomes from year 1 all the way to year 9. And after that, the growth rate will be 2%. So with this, we can be able to calculate the present value of the future cash flows past the 9th year. And we can also be able to calculate the present value of each net operating income. So for us to get the present value of the ABC apartments, we need to add the present value of each net operating income plus the present value of the reversion amount, which is also referred to as the resale price. So now, or rather, the resale value. So in Excel, since we have this, the net operating income, we can get the present value of the net operating income. And this is at 12%. So 12% is our nominal rate, which is already captured up here. So for us to get the present value, it's simply multiplying this, rather dividing this by 1 plus the rate and raised to the number of years. Now here, to make our work easier, let's simply lock in the interest rate so that we can simply drag it down. Now there we have the present value of each net operating income. But we also need to get the present value of the reversionary amount. Now, for us to be able to calculate this, we'll have to do it through the formula of the present value of a growth annuity. So for us to calculate that, we need the cash flow for year 10. So in this case, it will be this multiplied by 1.02, since 2 is the growth rate. And then with that, we also need to note our growth rate, which is 0.02. So the present value of the reversionary amount at the end of year, or rather at the beginning of year 10, which is the end of year 9. This will be equal this cash flow divided by the rate minus the growth rate. So this is the present value as of year 9. But we also need to get the present value of this cash flow at year 9, incorporating the 12% interest rate. What will be the worth of this amount today? So again, this we need to divide it by 1.12 raised to power 9. So we can add it here. It's equals to this divided by 1 plus our rate and raise this to 9, which is the number of years. So that's the present value of the reversion amount. Now we can calculate the total present values. So to do this, this will be equal to this plus the present value of the reversionary amount. So that now you can simply drag it down. So now we have the present value of each year, of each cash flow for each year. Now let's get a total of this. which is equals to sum, and highlight all of this. Close the brackets, press enter. So this is the total present value. Now here, for this particular formula, we've used the terminal cap rate based on required rate of return and expected growth rate in long-term cash flows. So let's look at another example where the terminal cap rate from sales of older comparable properties. So this information will be similar all the way to the 9th year, but we'll have to change the present value of the reversionary amount. So let's just copy this to a new tab. Okay, so now assume that we have two comparable properties. So here we have comparable properties. So for the first comparable property, the current net operating income is 400,000. And for property 2, it's 450,000. Now the current sale price the first property is 4 million, and for the other property is 4.3 million. Now with this information, we can calculate the current cap rate. For us to get the current cap rate, we simply divide the current sale price by the net operating income. So for the first case, it's 10%, and for the other case, it's 9.5. So now we need to calculate the average cap rate, which will be the average of both of these amounts. So the reversionary value can also be estimated based on the cap rate. So assume you have two properties here. The properties have different current net operating income and have been sold for different prices. So for the first example, your property has a net operating income of 400,000 and has been sold for 4 million. And the second property had a net operating income of 450,000 and was sold for 4.3 million. So with this information, you can be able to calculate your cap rate. So the formula for getting the cap rate, simply divide the net operating income by the sale price. And get the cap rate for each property. Now, with this information, you also need to calculate the average cap rate. So for a case here, we'll simply take the average of the cap rates, and here we find that our average cap rate is 10.23. So with this information, we're looking at the current sale price, which is at the beginning of year 10, which is also the end, or rather, which is at the next year after we receive the net operating income for the 9th year. So in this case, we need the net operating income for year 10, is the 10th year. So by that, we take our net operating income multiplied by the growth rate. Now with this information, we can be able to get our reversionary value, which now will be calculated by dividing the net operating income by the cap rate. And in this case, we take the average cap rate. Now this is the reversionary amount at year 10. And to get the present value, we simply take this reversionary amount and divide it by 1.12, or rather 1 plus the rate raised to 9. So that's the present value of the reversionary amount, which is right here. So now in our case, now our total present value has changed to 3.69, assuming we are using the cap rate of based or rather based on the current sale price of comparative properties. We can also estimate the reversionary amount based on the expected changes of the present value. So based on this information, we can be able to estimate the reversionary amount, which is assuming that the reversionary amount is equals to the current present value multiplied by 1 plus the growth rate raised to power n. So in n meaning the term which this particular person is expecting to dispose or rather resell the property. And also the formula of the present value is equals to the present value of the net operating income plus the present value of the reversionary amount. So with this information, we can be able to calculate the present value, and knowing the present value, we can then be able to calculate the estimate of the reversionary amount. So the way this works, we already have the present value of net operating income. This will be a sum of all the present values up to the 9th year. What we also have is the 1 plus g raised to n, which in this case is simply 1 plus 0.2 raised to 9. Now we also have, since in this scenario, after we multiply the 1 plus g raised to n, we need to divide it, or rather multiply it by 1 over 1 plus the rate raised to n for us to get the present value. So we can also calculate that. Which in this case will be 1 divided by 1 plus our rate here raised to 9. Then we need to multiply it. So multiply this by that. So now our equation will be the present value at time 0 is equals to 2.073 million 474 plus 0.43 multiplied by the present value at time 0. So for us to get the present value at time 0, we'll simply divide this, which is the present value of the net operating income, by 1 less at 0.43. So with that, we have our present value at time 0 will be equal to 3.643 million 827. We can then be able to calculate the reversionary value tier 9 by simply now taking the present value multiplied by 1 plus our growth rate all raised to 9. Now this is our new reversionary value. So we can also get its present value here by dividing it by 1 plus our rate all raised to 9. So now our present value will be equal to a sum all of these present values. So those are the different ways in which we estimate our reversionary value and use it to calculate the current value of the property. You can also be able to calculate the land values assuming highest and best use analysis. Land value is determined by subtracting the cost of construction from the total property value. So with this, let's look at an example. Consider an office building on a site that is expected to produce net operating income of 500,000 for the coming operating year. The investments are expected to last for 75 years. The net operating income is expected to grow each year by 3%, and investors expect an internal rate of return of 13%. Assume that a new building will cost 4 million to construct. Calculate the implied or residual land value. So first, with this information, we need to be able to calculate the total property value. For our case, let's simply go into Excel and be able to compute this. Now we have our net operating income as 500,000. What we also know is our growth rate, which is 3%. And then our IRR, or expected rate of return, is 13%. So the formula of getting the present value of a growing annuity is simply the net operating income, or rather the cash flow, the first year, divided by the rate less the growth rate, which is the internal rate of return less the growth rate. And so for this formula to work, the growth rate should always be less than the expected return. Now with this information, we now get that the present value, or the total value, the property, is 5 million. So the cost construction, for example, was 4 million. So now we can estimate the land value, which will be equal to the total property value less the cost, the current cost of construction. So we find that our land value in this case is actually 1 million. So it's also important for us to note that land values might change depending on the net operating income, expected values for the growth rate, and the expected returns of the investments. In the first example, for an investment with a net operating income of 450,000, assuming all other factors constant, that our internal rate of return is 13% and our growth rate is 3%, we find that the present value of the property is 4.5 million. For the same property, if the net operating income was 500,000, we found that the present value was 5 million. And in the event that it's 550,000, the present value is 5.5. So when the cost of construction is constant, we note that the higher the net operating income, the higher the land value. So that's key for us to be able to note that the changes in the net operating income and or the expected values for internal rate of return or growth rate are the basic causes of volatility in land prices. Now let's cross over and look another example where we're trying to get the highest and best use analysis of vacant land. So for the first use, we have an office. So at the end of the year, the net operating income is 500,000. And we also have retail space as an option where the net operating income will be 600, apartment will be 405,000, and the warehouse will be 400,000. But in this scenario, we have different growth rates and different expected rates of return. So for the office, the rate of return is 13%, and the growth rate is believed to be 3%. For the retail, our R is, or our internal rate of return is 13%, but the growth rate is slightly higher at 5%. And for the apartment, we have 12 and 3, and for the warehouse, we have 10 and 2 respectively. So as the formula held earlier, for us to get the present value or the value of the property, we need to divide the net operating income by the difference between the internal rate of return and the growth rate. So in this case, we'll find that the office property value is 5 million, retail is 7.5, apartment is 4.5, and the warehouse is 5 million. Now we also need to note what will be the cost of construction of each of these particular properties D. So we find that based on this estimation, the cost of construction for the office is 4 million, for the retail space is 6.75 million, for the apartment is 3 million, and for the warehouse is 4 million. So now we find that the implied land value hereby changes depending on the use of the property. So for the office, the land value in this case will be 1 million. And for the retail, it will be 750,000. And for the apartment, it will be 1.5 million. And for the warehouse, it will be 1 million. So land value is determined by its highest and best use, which is the use that results in the highest residual land value. So in this case, the highest residual land value is the apartment, which gives us a land value of 1.5 million shillings. So this is an important analysis which you can be able to use, since you can note that the net operating income for the apartment is actually lower than the net operating income of both the office and the retail space, but this gives us the highest and best use of the vacant land in consideration of the construction cost and the expected rate of return and the growth rate. Let's also look at another practical example where assume the facts in 6 above, which is the previous problem which we had. In addition, suppose there's an old warehouse on the site that is currently producing a net operating income of 192,000 and B, a net operating income of 168,000. The net operating income is expected to grow by 1% each year, and the required rate of return is 13%. The cost of demolishing the house is 50,000. Will the warehouse be demolished down and apartment built in case A and B? So with this, we already know the net operating income, or rather the expected net operating income for the apartment, which was 500,000. And with this information, we were able to get the property value to be 4.5. So in case of the warehouse A, the net operating income being 192,000 with a growth rate of 1% and an expected return of 13%, we get that the implied property value in this case is 1.6 million. And for property B, we get that the implied property value in this case is 1.4 million. However, in the first case for the apartment, we have a construction cost, which is 3 million. But in the other cases, we're assuming that they're warehouses. already on the property. So we don't have no construction cost. So the implied land value for the apartment, if we build the apartment, we'll have a implied land value of 1.5 million. So in the event of warehouse A, the land value is assumed to be 1.6, and for warehouse B, assumed to be 1.4. So this means that for the case of A, for property A, the net operating income of 182,000, the warehouse should not be demolished since the implied land value is actually higher than the land cost in the event that we were to build the apartments. But in case of B, the warehouse should be demolished and apartments built since the implied land value, if the property is left with warehouse B, is 1.4. Unlike if you built apartments, the property value will be 1.5 million. So for investment analysis, these are the motivations for investing in income properties. First, look at the rate of return. We also look at price appreciation, diversification, or even tax benefits. There are different investment strategies. So some of these core investment strategies include the following: investing in core properties, investing in core properties with value add strategy, property sector investing, contrarian investing, market timing, growth investing, value investing, or finally, development. Investment analysis refers to analysis of a particular property to evaluate its investment potential. Investment analysis answers the following questions: should the property be purchased? How long should it be held? How should it be financed? What are the tax implications of owning the property? How risky is the investment? So how do we know whether a property should be purchased? The internal rate of return will be greater than the required rate of return. The present value will be greater than the purchase price. The different measures of investment performance ratios. So first, we have equity dividend rate. We get the equity dividend rate by dividing the before tax cash flow by the initial equity investment, where the equity investment implies the cash investment made by the investor directly to the property and not the debt. We also have debt coverage ratio. This is calculated by dividing the net operating income by the mortgage payment. Taxation for income producing properties or for income producing real estates will also be paid key attention to. So the taxable income from operations of real estate is equals to the net operating income minus the interest and also less the depreciation allowance. Taxable income from disposable taxable income from disposable of taxable income from disposable of depreciable real estate is equal to the gross selling price less the selling expenses and less the cost of the property. Now let's look at an example. Consider the possible purchase of an office building by an investor for 8.5 million US dollars, financed 70% by mortgage and 30% equity. The cost of land was 1,275,000. The property is depreciated on a straight line basis over 39 years. The property is leased out for 5 years, and the projected net operating income and other information is as follows. So based on this table, we know that the outlay at time 0, which is today, is 8.5 million. The net operating income is as illustrated in the second row, whereby the first year you have a net operating income of 922,750, all the way to the fifth year, where you finally have a net operating income of 1,008,951. We also note the following payment. For year 1, 689,025, all the way to the fifth year, where you have 689. Now with that payment, we also note the mortgage balance at the end of each year. And we also have your interest amount for each period and the principal amount. Now, the loan is amortized over a 20-year term at an interest rate of 10%. The initial capital gain tax is 15%, price appreciation, and 25% on depreciation recapture. Tax on income is 36%. The required rate of return for equity is 12%. The property can fetch 9.7 million at the end of year 5. So we're required to compute the present value of the free cash flows to equity. With that, let us cross over to Excel. So with this information at hand, before we even begin looking into the details, we first need to categorize these cash flows into two. So we have cash flows from the sale of the property, and we also have cash flows from operations. So let's look at the cash flows from sale first. So on the first column, here we can have a description, and we'll add the amount. So cash flows from sale, first, we need to note how much is this property being sold at. So based on our example, the property can fetch 9.7 million at the end of year 5. Here, we can have our 9.7 million. But at the end of year 5, we also need to less the mortgage balance. Since if you're selling this property at the end of year 5, you haven't cleared your loan. And based on our example, the mortgage balance at this particular time was 5,343,245, as it was illustrated in the presentation. So with this information, we can get a before tax cash flow from our sale. Which will simply be the sale less the mortgage. So this means this is the cash which comes to the investor immediately after selling the property at the end of year 5 and clearing the loan balance. So they're left with this amount, the 4.356. However, this amount should be taxed. And the way taxation works is that there's a capital gain tax of 15% on price appreciation. And there's a 25% on depreciation recapture. So with that, we can simply note these two figures here, since they must be deducted from our amount. So first, we have our price appreciation. So in this case, the price appreciation equals to the sale price less the buying price, which, for our example, the property was bought for 8.5 million shillings. Then we also need to note depreciation for the 5 years. Now, this depreciation was done on a straight line basis over 39 years. So what we need to note first is that if the property was being sold for 8.5 million and the cost of the land was 1.275 million, so which means the value of the property will first be equal to 8.5 million less 1.275, and the depreciation for each year will be gotten by dividing that amount by 39. So in our case here, we have the 8.5 million less 1.275 less by 39, or rather divide by 39. That's the depreciation for each year. So what we need is the depreciation for the 5 years. So that will be simply 5 multiplied by that amount. So in that case, we find that our depreciation is 926,282. That's a total depreciation 5 years. Now, we need to get the taxes. So for us to get the taxes, we first need to note the tax on price appreciation. Which is 15% multiplied by our price appreciation here, which is 180,000. We also get the tax on depreciation, which was a recapture of 25%, which is 0.25 by the accumulated depreciation. Now, with that information, we can get our total capital gain. In this case, will be equal to this as that. So that's the total taxation, that particular period, which you can simply now add there and get our after-tax cash flow. For us to get our after-tax cash flow, we simply take the before-tax cash flow and less the total taxes paid. Now that's our after-tax cash flow from sale. However, also in this scenario, we also need to note the before tax cash flows from the 5 years. So each year we have the net operating income, and each year our client has been paying the mortgage. Let's just put this in bold, since we'll have to use it somewhere later here. So we have the first year, second year, third, fourth, the fifth year. So the net operating income for first year, based on this example, is 922,750. Second year, we have 948,568. The third year, we have 974,146. The other 975,080. And for the fifth year, we have 1,008,959. This net operating income is all based on let's just put this first. It's arrears. It should not have decimals. So the net operating income is based on the information collected or rather issued for this particular property. However, the mortgage was a constant mortgage of 689,025. Now this amount is constant throughout the period. So with this, we now have our before tax cash flow, which in this case is equals to the net operating income less the mortgage. You can simply drag it. Now that's the before tax cash flows. Okay. Now let us proceed and look at the after tax cash flows from operation. So for this case, we had our cash flows from sale. Now we can look at after tax cash flows from operations. Now the tax flows from operations entail the relevant deductions of the taxes on income for each particular year. So with this information, we need to calculate our taxable income. So first, we have our net operating income, which we had earlier on indicated. For the taxable income, we need to less our interest. And we also need to less depreciation. And with that, we'll be able to get our taxable income. So the interest for the first year, based on our example, is 590, 569. Second year, we had 580, 259. The third year, we had 568, 869. The fourth year, we had 556, 288. Fifth year, we had 542, 388. Now, depreciation, as it was earlier mentioned, is equals to the property value divided by the depreciation period. In this case, we say that the property purchase amount, which was the value at purchase, was 8.5 million. The cost of the land was 1275. And then it's being depreciated over 39 years. Now that's our depreciation amount for each year. So here we have the years. So our taxable income will therefore be the net operating income less our interest less depreciation. You can simply drag it with here. So for each year, you have to less the interest and the depreciation. Now, once you get your taxable income, you need to calculate the tax, which in this case, you are told that the tax on income is 36%. So you need to note the tax on income is different from the tax on capital gain. So for our case here, we have 6%. So we simply take the taxable income and multiply it by 0.36. Then you can simply drag it so that now we have the tax for each particular year. Now with this information, we can calculate the after-tax cash flow from operations. The way we do this, we need to note first the before-tax cash flow from operations less the after-tax cash flows. So before tax cash flow for the first year, we had already computed it up here. Now we can simply drag this over. That's our before tax cash flow. Then we need to less the tax paid, which in this case, this amount here. So you can simply drag it. So the after tax cash flow is now equal to the before tax cash flow less tax amount, and drag it to the end. Now we have the after tax cash flow for each particular year. Now we can also highlight this and have them with same decimal points for better clarity. Now this is the after tax cash flow from operations. So here, this was our before tax cash flow from operations. It's just for better clarity. Now with this information here, we can easily have the timeline or of each cash flow. So we have year 0, which is today, end of year 1, then we have year 2, all the way to year 5. So at the beginning, let's note the before tax cash flow and the after tax. So at the beginning of this investment, the client put in 30% of the sale price of the property, which is 30% of 8.5 million. So this is a negative cash flow. Is equals to negative 8.5 million multiplied by 30. So particular investor invested 2.5 million. So this amount is the same before tax and after tax. Since it has no tax, you get no tax when purchasing. So there's no tax indicated here. However, the cash flow from operations, or the before tax cash flow from operations, are as highlighted here below. We'll take from year 1 to year 4 first. Now I'll explain why we're doing this separately. On year 5, we have a cash flow from operations, the before tax cash flow from operations plus the before tax cash flow from sale of the property. Okay, and the same applies for the second case where we're looking at the after tax cash flows. Now we only need to copy the figures only. Then this case, or to make it even more accurate, let's just make it equal to that and drag it all the way to the fourth cell so that we have the cash flows up to year 4. But for year 5, we have the cash flows from operation plus the cash flow from sale of the property. Yeah. Now, with that information, we can now start solving our problem. So the first question was compute the present value of the free cash flows to equity. So with this information, we need to know the required rate of return for equity. So this is the expected rate of return for the investment. So for our case here, the expected rate being 12%. So we can calculate the present value of the before tax cash flow, which will be equal to PV or rather, in this case, since we have these cash flows, even to make it more easier, let's do the present value for each year. So we take the present value cash flow divided by 1 plus R, expected rate, raised to N, which is number of years. Then simply lock in this rate so that you can simply always remember to put in the brackets properly. So our present value will be equal to the sum of these cash flows. And our net present value will be equal this present value of the cash flows less the before tax cash flow. So in this case, it's equals this. Now we can do the same, the present value of the after tax cash flows. So with that, we'll simply drag this down, or rather not. Let's just do that. So the present value is equals to the after-tax cash flow divided by 1 plus our expected rate of return raised and then you can drag it. So for us to get the total present value from year 1 to year 5, simply get a sum of all the cash flows. And for us to get the present value, we'll take the present value, the positive cash flows, and less the initial amount paid for the investment. So that's present value of the after-tax cash flows, or rather the net present value. With that, we are done with the first problem. So let's call this A, present values. Now let's go to B. So the second question was, compute the after-tax equity IRR. Tax equity I. Now the formula of getting this, so we first need to note the after tax cash flow IRR. So this is equals to IRR into brackets. Then we highlight all the cash flows or the after tax cash flows. And then we can give a guess of our expected rate, let's say 0.1, for example. Then press enter. So we find that our after-tax IRR is actually 15.75%. Now let's compute the equity dividend rates for year 1 to year 4. The equity dividend rate is gotten by dividing the before tax cash flows by the initial equity investment. So let's go to question C, which is equity dividend rates. Year 1 to 4. So here we know the years. Then you need to note the before tax cash flow. And simply note that I've simply picked these cash flows here. Then the initial equity investment. So in this case, is equals to the 8.5 million less 12. No, the initial investment was 30% of 0.85. 0.3. Okay. So that's our initial equity investment. So with this, we can be able to calculate the equity dividend rate for each year, which will be simply the before tax cash flow divided by the equity investment. So the equity investment note is at times 0, or the initial. So this does not mean that it's being invested each year. Just put it there for easier calculations, and then this indicated as a percentage. Unable to do at C. Let's move to the final question. For the final question, we are asking compute the debt coverage ratio for years 1 through 4. So first, note the year. One to 4. And for us to get the debt coverage ratio, simply take the net operating income and divide it by the mortgage payment. So we had earlier indicated our net operating incomes 1 to year 4. And we had also earlier indicated our mortgage payments. Is this 1 to year 4. So for the debt coverage ratio, we will take the net operating income divided by mortgage, and that's our debt coverage ratio for each year from year 1 to year 4. Now with that being done, we've come to the end of that particular chapter on income producing properties. So feel free to refresh your memory by going through again the course material and attempting the quizzes here below.